Hi everyone. I've spent the last couple of weeks in the United States, about to fly back home. I came for a tech conference run by Morgan Stanley in San Francisco. So it's pretty interesting to see what was going on in Silicon Valley. I was there when the Silicon Valley Bank collapse was going on. It was obviously had a very kind of particular vibe. I remember having lunch with a VC that weekend who had a number of companies who basically all banked with Silicon Valley Bank, including one that had 60 mil. So the the Fed basically guaranteed all those deposits too late for Silicon Valley Bank. They also created a facility whereby banks can put underwater treasuries and basically swap them for liquidity. This is exactly the kind of thing that would have saved Silicon Valley Bank, funnily enough. So they brought in the facility just a few days too late. I think it's kind of interesting to see like how many banks have actually have a similar problem. So this shows Bank of America, which has a 224 billion market cap. They've got over $100 billion of unrealized losses on their debt securities. Now the vast majority of those probably are fine if they hold to maturity. Agency mortgage-backed securities, you can see 20 billion of that is US Treasuries, and it's not completely nonsensical for the US to set up a facility for people to swap those. Like if you park US Treasuries with the US government on a hold to maturity basis, that's pretty reasonable. But it really does show like this crisis was almost entirely caused by rising interest rates. They really it wasn't a case of, Silicon Valley did make what could be considered risky loans to venture capital funded firms and venture capital firms. But that wasn't the problem here. The problem was actually the unrealized losses on their portfolio. So when liquidity ran out and everybody ran for their money, they couldn't access any liquidity other than to realize huge losses on these held to maturity debt securities that have wiped out their capital. So it really was like an interest rate driven thing. And it's interesting to note like how widespread this problem is. Now, typically if there's a bank run, effective government guarantee often stops it. I don't think that's the case this time. And indeed, that's basically how it played out last week, where it continued. The reason for that, I think there's two reasons why it continued and probably will continue. The first is it doesn't matter if the government's guaranteeing your deposits. If you're in a bank that goes bust, it just doesn't look good, whether you're the parent of a household who needs money, or if you're a treasurer or accountant with a small, medium enterprise or a larger one. You just looks really bad and reflects very poorly on you, however unfairly, if your money is stuck in a bank that goes under. So the fact that there's some effective federal guarantee, I don't think really makes a difference. Everyone's going to rush their money into other alternatives. Now the second major issue is that with this extremely radical policy of raising rates, almost like basically as fast as they've been raised in our lifetime, with unknown second, third, fourth order effects. Basically, at the moment, you can get a far higher interest rate in a money market account, even in a brokerage account, than you can get at a bank. Now, the reason for that is a lot of banks lent out money at these low rates. If you think about everyone in the United States with a 2% mortgage, somebody was on the other side of that trade. Somebody lent that money, and that mortgage is very, very underwater. 30-year, something with a 30-year zero coupon bond, moves 30% for every 1%. Now, obviously, bonds get amortized, so the sensitivity is a bit lower, but still there's huge losses, unrealized losses in the banking system caused directly by these interest rate moves from the government. And that means that, banks just can't afford to pay more than nominal amounts. So there were a few people that seem to think that like Bank of America and Wells Fargo would catch a bid, that as they were now the natural kind of destination for these kinds of funds, that they'll do well. But really, I think it's just waking everybody up to the fact you can get so much more in a money market fund, or by basically in US Treasuries, where your counterparty is the government. You have no risk of the bank going under, and that's kind of caused put a lot of pressure on these stocks as well. And this is going to be the case. The Fed seems to think they can they're just announcing massive new liquidity measures. I'll show some charts on that. But the reality is, while they keep raising rates, and there's still assigned a very high probability of raising rates next week, they're not going to solve the problem. There'll be a continued massive rush of deposits out of the system, out of the banking deposit system. You can see that regional banks have had a very tough time of it, and they can now join the long list of assets with negative 5-year returns. And you can see that volume is truly exceptional. There also seems to be something of a regime change. I mean, there was a huge amount of liquidity issued. You can kind of see, this is kind of zoomed in. The Fed Reserve, when they created this facility, basically did offer a lot of liquidity to the system. So what it did is, let's say you're a bank and you've got these underwater treasuries that might be 20-30% underwater if they're very long term, certainly 15 to 20%, which are huge numbers on $100 billion loan books or treasury portfolios. You weren't able to use that. Like, that was in your hold to maturity basket. So you couldn't use it to pay out deposits. You couldn't really use it in any kind of way, any kind of liquid way. By the Fed offering to liquidity at par in return for those securities that I guess the US government issued themselves, that basically does like liquefy all those reserves. So there is liquidity going into the system. And, this is something we've kind of been, I guess, waiting for as kind of growth investors. I mean, the tightening liquidity had dramatically underestimated the effect that would have on long duration assets. And the moves have been extreme. So it's interesting to note now that has so decisively reversed over the last kind of week or so. And you can see here, this is that discount window borrowing has just been immense. So this is banks tapping that new facility, swapping their underwater securities for par value liquidity. So not having to realize losses. Another interesting thing about Silicon Valley is, I guess, everybody's talking about AI. I don't think that's a Silicon Valley thing. I think it is truly revolutionary. I think it's funny that this is kind of like Microsoft Word doesn't look like this now. But there's kind of been, there was a really clear kind of difference in outlook between two sets of tech companies, or rather three. So where I think the opportunities are now are basically in semis, big tech cost outs, and the hammer of those cost outs, other than landing on, employees who are judged excess painfully, is going to be on small companies. So you can see there's a huge opportunity to lower headcount. This is Facebook or Meta's headcount, and they've announced now 21,000 jobs out of 86,000 at the end of last year. So that's a huge savings that can potentially come through the pipeline. And I learned a little bit from looking at companies. A lot of the small caps are outlook seemed pretty bleak, not like kind of despairing, but just kind of resigned to a difficult year. A lot of companies kind of guided to flat or much lower growth than everybody was expecting at this conference. But really, these every time someone leaves one of these big companies, that's a bunch of software licenses from Microsoft to Salesforce to the 20 different things, GitHub, maybe GitLab. When all these licenses will go as these jobs go as well. And so you kind of have some clear winners. You have companies like Google and Facebook that have a huge amount of fat to cut. So every dollar of revenue of cost they save basically adds somewhere between 10 and 20 dollars of value. On the flip side, that's a dollar of revenue gone from these licenses and these other expenses. I'm talking about obviously those kinds of costs. So there's some pretty clear winners. And actually, the last week, I mean, a swallow doesn't make a summer, but the last week you actually saw this move in force. So you saw big tech ripping, but a lot of software companies pushed to significant new lows. And it's kind of interesting that the red hot sector which was B2B SaaS for basically from 2016 to 2021, is going to suffer the most. So it's interesting that that it was already the hardest hit in share price, and now the fundamentals are coming through. And it's really lesson when I think about obviously we lost far too much last year. When I think about it, it was really the prices moved much faster and much quicker than the fundamentals, and now it's kind of this year you're getting the huge growth slowdowns. I've got some examples of that. Oh, first of all, trying to tell somebody that the bull market from 2009, it wasn't just a COVID rip. Actually, there were multiple times where similar movements happened. So there was 140% from the 2009 low to 2011. Then there was 116 from 2011 to 2016, and then 140 from 2016 to I guess that's 2018. So the moves that we need, do happen. And obviously, small cap growth companies did much better than this, multiples of this in many cases. And now this is a kind of assessment of where multiples are, you can see that Salesforce is right at kind of basically almost a lifetime low, other than the GFC. So it's not at 10-year lows. It's kind of like it's as low as it got, pre-GFC, and certainly in the period after. So we are getting there on multiples. I'll put this tweet here. Elon Musk: the Fed is operating with way too much latency in their data. So I've been writing about how there were big inflation months this time last year, with the Ukrainian war in Fed March, April, May. Those were skewing the year-on-year numbers, and as those high inflation months roll out of the series, inflation's much lower, and that's continued to happen. So there was big inflation's still 6%, but 70% of that was shelter, which is a lagging indicator, we know is coming down, and PPI, which is one of the things the Fed looks at very closely, or most closely even. It's annualizing at 0.8% of the last 8 months. So it's annualizing at 0.8%. So it's February, March, April, May that were the worst months for inflation last year. So as they roll out, those inflation measures could drop like a stone, right as the tightening that the Fed has been doing really comes into swing. The other thing to note that's a bit of an unknown now is those small regional banks that I just showed a slide of the share prices collapsing, and have pretty strong conviction that deposit outflow is going to continue due to the fact that the Fed has raised interest rates on short-term risk-free debt so high that it makes sense to do that, and also just people want to avoid the embarrassment of being in a bank that goes under. The combination of those two things is really bad for regional banks, but these are regional banks do like 50 to 60 to 70%, depending on category, of lending across the United States. So how much will they pull back? That's a big unknown at the moment and a big risk. I thought it's interesting, I was saying that the small cap tech got smashed. Companies like GitLab dropped from 135. I think the low was $30. They had a massive stock-based comp blowout, which was not what the market wants to see right now. It's still very expensive. But I thought it was curious, Google Ventures, one of the Google entities that bought, and the 3 collapses in the share price, they've bought each time. Basically at the lows, the interim lows. And it's curious to know, will they actually buy this out? There's good reason. Microsoft bought GitHub, which most people would be familiar with. GitLab is kind of slightly more comprehensive, just like one developer platform that replaces all of your developer tools, and you do kind of all-in-one interface. Very popular with enterprise, but doesn't really have a strong AI component. Whereas GitHub, which Microsoft bought, has been leading the charge there. And it turns out that coding, of all things, is probably one of the best things suited for AI, which is fascinating because everybody thought that the coders would be the last to go, and they're the ones being disrupted the most. Now, I don't think they are being disrupted. I think actually what it means is you can become extremely good with very little. Every coder just becomes vastly more powerful, and certainly can build a lot faster. The consequences of that are unclear, but I would say, I've been playing around with it, and it's amazing. There are things that I've built in the last kind of few weeks that I've tried multiple times in the last few years and just kind of hit a roadblock and got stuck and moved on to something else. But with these AI tools, you just kind of plug in the error codes until it corrects it, and then you've got something that works. It's pretty incredible. These are the kind of sales. You can see pretty meaningful amounts, like 18 million went through the market in terms of Google buying GitLab shares. A big worry is this chart shows Datadog's guide. So Datadog was one of the darlings, kind of like the other companies have been smashed, like Bill.com. Like these were really the most popular stocks. Even last year, they're kind of outperforming all kind of small mid-cap growth and biotech. But you can see they guide it to basically flat quarter on quarter. So this is a growth stock that's not growing, down from 60% plus for many years. That's kind of a problem because these companies are not making money. If they're not making money, they're not growing. All of a sudden, it becomes very difficult to price them. And if you add in the fact that we know that seats are just disappearing across the tech space as companies like Meta, Facebook cut 20,000 plus jobs and probably more. It is a real problem. It's a real problem for these companies because they're still trading at $20 billion plus vals on less than $2 billion of revenue. This is Datadog's numbers, so you can see there's pretty solid growth. But this is a company that lost 50 million last year on 1.3 billion of gross profit. Now, is that worth 20 billion? Is it worth 3 billion? Is it It's very hard to say. If you have confidence in the growth, and it's going to be 3 to 5 times as big in 5 years, which, by the way, is something that many of these companies achieved. And it's kind of what drove our returns when the fund was performing well. But you can't necessarily say that now because the numbers aren't doing that. And if anything, if you look at the environment and what we're seeing in the announcements, there's more seats to go, across the software space. And I'm just using this as an example. You can see, like, even on a cash flow basis, it's got 400 mil of cash flow. I mean, is that worth 4 billion or 20? You could argue at the moment potentially the lower end of that. And Google now is on something like 10 times EBITDA. So if you put 10 times operating cash flow on this, Google's actually growing a bit faster than Datadog if growth is 0. That's more like a 4 bill val, which is a huge difference to the current share price. And that's even assuming, like, this stock-based comp line doesn't matter, which it does. Because one thing every employee is doing when they get their shares is hosing on the market. That's another thing that was loud and clear when you speak to employees at these companies. And this is an example of, what happens, like, even within the software space, a lot of these companies end up at 3-4 times sales, which again means further downside for these companies. And then you compare that to the cost out opportunity and the increase in profits and margins that are going on in big tech, and the fact they're pumping tens of billions of dollars into buybacks versus, obviously diluting the share count here. You can really see, like, a reason for that rotation that might have only just started. I wish I sent this out a couple of weeks ago because that was the big takeaway from this conference. These are just some more examples. I thought CrowdStrike was interesting. So it has come off a bit from the lows. It was down, I think, about 70%, maybe 75% actually. You can see it's got pretty solid growth, and the growth seems to be continuing. You can see gross profit dollars are up over 50%. And it's roughly kept the gap loss in line, 40 mil gap loss. But the interesting thing about this, it's actually generating, like, a lot of cash flow. It seems I've taken the slide out, but CrowdStrike generated, almost $1 billion of free cash flow, and not all of that was stock comp. A lot of it wasn't. So that company's going to end up with, like, a huge cash balance if this market continues. So I think it's one of the favorite stocks. Even agreeing that there is competition from Microsoft in what they do. So far, CrowdStrike is considered the best of what they do, but they are up against Microsoft. And, it's funny when I look at all the work that not only just me, but everybody in the tech space did on small and mid-cap growth, how powerful Microsoft was, how aggressive they're being against Google, even in search right now. This is a truly formidable company. Having said that, CrowdStrike is fending them off at the moment, doing a pretty good job of it. I thought I'd finish on one other company. So this was one that kind of really damaged us last year. It was one of the companies that went up, I think, 8 times from when we bought it, and then absolutely collapsed last year. This is C Limited. So the real issue with C was it was a very competitive market in commerce, and gaming revenues collapsed, and they also got banned from India, which was like a direct bite out. So they were making billions of dollars of profit from gaming and using that to fund an aggressive expansion. Europe, South America, India, everywhere, well away from Southeast Asia. So they lost billions of dollars of profits at the same time as they were ramping up their expansion. I remember last quarter, in, like, stark contrast to the kind of very wimpy statements from some of these small and mid-cap CEOs, but they really don't. It's hard to describe. They don't seem to really care or mind their stocks getting smashed. They certainly don't see a problem with paying themselves and everybody around them tens of millions of dollars. I'll give you an example. So Twilio CEO speak, and he was in the main room, and he's got, I don't know if there was like 100 people, I don't know how many people in this room. It was a big room, maybe somewhere between 80 and 150 people sitting in this room, and they're all buy-side analysts, a lot of long-short people, a lot of, like, I guess you'd say, some people might disagree, but I'd say very sophisticated financial people in general, certainly very critical, very skeptical people, especially now. Your stock's gone from, like, 360 or something to $60, and now you've got an opportunity. At one point it was trading at just over 1 time sales. It's trading down to half cash. You've got an opportunity here in front of all these people to, like, lay out a vision, but most importantly, talk numbers and give people some confidence. And there were plenty of CEOs that did that. But he just waffled on about the importance of the customer. It was like, you've got an hour with like over 100 people perhaps, who collectively probably run, the majority of buy-side capital, both hedge funds and long only, and you're choosing to like lecture on the importance of putting the customer first. It was a huge contrast. Whereas Forrest Lee, the CEO of C Limited, in his last quarterly, which should have paid more attention to, but he came up with really fighting words. He's going to do it. He's going to cut costs. He's going to rush. And he sees the danger. He sees it's existential, and he's going to do every effort to do, no matter how painful it is. And they guided to basically by the end of this year being profitable. And you can see here, and who knows where they shuffle costs, but on a GAAP basis, so a fully GAAP basis, they went from losing 600 mil to making 400 mil for the quarter. So that's like real P&L. That's like, I don't know if you analyze that, not that I'm saying you necessarily can, but were you to analyze it, it's like 1.6 bill a year versus a market cap that got down to, I think, 20 bill. And that's a huge, and you can see how he's done it. So gross profit was up 30%. And actually, digital entertainment, the gaming was exceptionally weak, down 33%, but e-commerce was exceptionally strong, up 50%, and he kept the cost of e-commerce flat, and the cost of digital entertainment fell in line. Now, that is hard to do. Businesses that shrink are really hard to manage. It's like businesses are healthy when they're growing. It's very hard if revenue's shrinking at 30% to shrink your costs at 30%. It's also very hard if your revenue's growing at 50% for e-commerce to keep your cost base basically flat. The other thing he did is, you can see here, he dropped sales and marketing from 1.2 billion to 473. So a 61% drop in sales and marketing expenses. And broadly, it seems he didn't lose market share because his two competitors, Tokopedia and Alibaba's Lazada, basically all doing the same thing at the same time. Everyone's kind of rushing to profitability. The whole industry's rationalizing. But I thought that was an astounding kind of result to make such a move and to move to GAAP profitability in the first month of this year, whereas everybody else is massively missing. And kind of, the best case scenario is something like CrowdStrike, where your GAAP loss is roughly equal, but you're 50% or 60% bigger. This is kind of how you do it. And I think the way this plays out for these kinds of companies is at some point over the next year, one by one, the CEOs will take this route. You saw Zuckerberg do it. You're seeing Forrest Lee do it. They're basically going to say, they're just sick of their share price going down. They're commercial animals, and they're like, okay, we're going to cut costs and get to profitability. It's a decision. You have to make it. There were so many CEOs that I heard speak that just weren't even thinking along those lines. I think it's hard. Like, think about the other thing that shocked me or surprised me as an Australian is how much these people get paid. Like, there's a good chance that everybody around the CEO of Twilio is getting paid, $5 million US plus, maybe even 10 million US plus. I remember like the senior executives at Twitter that were fired when it came out, they're all making like $15-16 million. Like, that's crazy. I mean, I think if you're a startup CEO, it's so hard to make $1 in this world. But then, maybe 7, 8, or maybe 10 years later, you're a billionaire, you're surrounded by people you're paying 10 mil a year, and they just fill you with all this hot air, and you don't really see the danger. But there are CEOs one by one that are going, okay, I'm going to just cut costs, move to profitability, I want my share price up. And this is actually what kind of finally happened. So you can see here, this is really what these are the kinds of moves that kind of caused so much damage to us last year. There's a ton of companies that look like this, but it's C, Square, anything in biotech. And you can see it's kind of been basing for a while. And then on these announcements, seems to have put in a base, and is certainly a series of higher lows and higher highs. And that's super encouraging. So I think we're going to orientate. We have bought some big tech. We've been pretty aggressive in semis, which paid off. Funnily enough, I don't think we made a huge amount of. We made money out of Nvidia, AMD, ASML, but we still had some of these software names that just kind of gutted us. But I think going forward, I think you have to be in companies where the CEOs have that kind of clarity of vision that they're going to be aggressive on costs, because all kind of outcomes are now really open. If they do another rate rise here, that's going to increase the flow of money towards treasuries dramatically. The market's already starting to price in cuts. The good news is that there does seem to be something of a phase shift. So we could be in the early innings of a regime shift. You're seeing old economy stocks down, treasuries up, big tech up, small cap, like companies that are diluting too much are going down. That's kind of like universal in most markets, actually. And even the companies diluting the most, they weren't 2 to 3 years ago. A lot of them were gap break even, but they just took it upon themselves in the last year to blow out costs. I think there's a good chance we're in a regime shift where you actually get rates going down, old economy slowing, people start wanting the free cash flow and the rock solid balance sheets of big tech rather than the cyclically exposed, chemicals, metals, mining, industrials, which also have a fair bit of debt. You could really see the first stages of that, but it remains to be seen, I guess, what happens next. Certainly the phase of this crisis where multiple banks are going under, you're getting emergency bailouts on the weekend, you're getting new liquidity mechanisms, liquidity in the system is going up rather than down for the first time since this market crash kind of started. Those are all encouraging signs. I've written a lot of notes about this Silicon Valley trip. I think I'll kind of jot them out into maybe even company by company and share them with anyone who's interested. It was pretty fascinating, but kind of synthesizing it all, it really was the haves and the have-nots. It's the ones that were cutting and going for profitability, and then there were those that are going to be cut, those that are selling these software licenses and seats and are going to be the receiving end of those cuts, who at the same time don't really seem to be bothering to do it themselves. So you can kind of see how this ends now as well. So at some point, the growth in big tech seat numbers will normalize. And of course, we've got this amazing new modality in AI, which is attracting a huge amount of funding and is hiring. So that is kind of the fascinating part of where we are. I have noticed this year's been interesting because on the one hand, you have absolute boom time in semis while the rest of tech is struggling. It's truly kind of a tech revolution going on while in the middle of a tech crash. So I guess the right play here is probably the obvious one. And I think looking back over the last 12 years, generally the obvious plays are the correct ones. So you want to be in big tech, you want to be in semis, and you want to avoid companies that are diluting too much. Within that, the original thesis almost certainly plays out. The companies that grow the fastest and grow the most over the next 2 to 3 years will probably have fairly spectacular returns. And you're just starting to see kind of the beginning of a regime shift where it finally starts to favour some of the names that we look in. So obviously we're going to have to keep an open mind and we'll just have to see what the week brings us. Hope you have a fantastic week and hope you've enjoyed the weekend, and I'll do this again soon.